and welcome to What the World Wants. In 2 to 3 weeks from now, the new government will present its first budget, its first major policy statement on where it will crunch, where it will invest, who and how it will tax, how and how much it will spend. Indian equity investors have already pulled Indian equity indices by over 20% year to date on hopes of better performance from this new government. But what exactly do these investors want? That's what we ask in this show, What the World Wants. We kick off the series with Geoffrey of UBS and Adrian Mowat of JPMorgan. Let me start with Geoffrey, who joins us all the way from New York. Jeff, thank you very much for joining us in this maiden show. Well, first up, what's your view of Indian equities? Do you see, in fact, more juice in the Indian markets at all, since we have already risen about 20% year to date?
Yes, we think there's a little bit more upside in the market. We estimate the market's going to go up by another 5 or 6% between now and the end of the year. Really because the reform process which we expect the new government to put in place probably still has the potential to drive the market a little bit higher. But obviously, as you said, we've had very big gains already this year, and so I think we've seen the best of the gains, but we don't particularly think it's a sell. We think there's a little bit more upside.
Well, a little more on the global scenario now. You know, U.S. Treasury yields have been rising, from 2.4 to 2.6% lately. Do you think that carry trade could unwind, and hence we could see actually outflows from emerging markets as U.S. yields continue to pick up later this year?
I don't think the flows will end, because I think any reversal of the carry trade will be somewhat less dramatic than it was in January. And of course, we had a big sell-off in emerging markets last summer when the tapering scare first happened. So we don't think it's going to be as severe as that. But we do certainly think that over the rest of this year, U.S. bond yields will rise to around 3.25% on the 10-year yield at the end of the year. We will get a more broad-based dollar rally than you've had so far. And that is going to put some of the, what we could call the carry currencies under a little bit of pressure.
Geoffrey, what are your top 3 equity markets at the current juncture?
Well, we focus on equities within emerging markets here, and our thesis is that we like, and we've been this way for quite some time, we like markets where the fundamentals are fairly sound, which means they're not so dependent on foreign capital flows in an environment where we do expect the dollar to rally later this year. And we also like markets which are leveraged to the pickup in the global economy, which now is almost entirely going to be due to the pickup in the developed world. So our 3 top markets against that background are Korea, Taiwan, and Mexico. They're all overweights. They all run either current account surpluses or, in the case of Mexico, very small deficits. And all of these economies are tied very closely in with the U.S. economy. We also like Poland, which is tied into Europe. We also like Colombia, which is tied into the U.S. also. And those would be our top favorite markets right now.
Okay, now coming to the whoop and woof of this show, what would you watch out from India in policy terms, especially from the budget which is due in a couple of weeks?
Well, I think the challenge is going to be the speed with which we start to see these reforms being announced and being put into practice. I mean, one of the very exciting things about India, I think, right now, is that with the new BJP government having a sizable majority in the parliament, in the lower house of parliament, I guess, we feel that the reforms, when they are announced and come through, should be able to be implemented relatively quickly. So from the budget itself, we would look to see for some clarification in terms of potential infrastructure projects. We'd like to see some sign that some measures perhaps taken to remove some of the bottlenecks in terms of some of these projects. We also wonder whether we might see the initial steps towards what is, we assume will happen under this government, the creation of a new goods and services tax for a broad nationwide indirect tax. But in general, I think your triggers are going to be when you see some of these structural reforms coming through, which will spell better growth prospects for for the Indian economy in the future. At the same time, we want to see signs of further potential downward pressure on inflation. We want to see what the central bank is going to do as another reason eventually to be constructive on the market. So those are the sorts of things we're watching right now.
So what would your sectoral preferences be in India? Is it sectors like IT and pharma which have dollarized earnings, or would you prefer cyclicals that are more exposed to the domestic economy?
We would prefer more domestically orientated cyclicals. We would also have some sort of exposure to the Indian banks. I mean, I think the way you look at the Indian market now is to say that the growth has been very disappointing. We've gone from 9% growth 3 years ago to 5% growth now. The market has rallied very sharply, 35% or so, since August of last year on the anticipation of the reforms, of a victory for BJP, and under Mr. Modi the reforms started to come through. I think the market didn't fully price in the election result ahead of time because there was some concern about the accuracy of the opinion polls. Now we have the results. Now the promise of reform is there. This is why I think there's still some buying of India going on. And now it comes down to waiting for the reforms to come through. And most important of all, seeing those reforms deliver stronger growth. And I think if that is what we anticipate will happen, which is certainly our view over the next 12 to 24 months, we would rather try to play those by having some cyclical exposure within the Indian market. We don't think the market is particularly expensive. It's a little bit on the rich side, but we don't think it's that expensive. And I think you should also expect to see something like 15% earnings growth in India, both this year and next, which by EM standards is quite good. So there are reasons for India to continue to move higher, although we doubt it's going to be an outperform. We think it's more of a neutral within EM overall, but certainly it's all now about the delivery of the reforms and, above all, the translation of those reforms into stronger growth.
Well, Geoffrey, the latest inflation number was actually higher than anticipated, a good 80 basis points higher than the previous month's inflation reading. Does that worry you? Separately, what are your thoughts on the currency? Where is that headed for the rest of 2014?
We certainly think inflation is a concern in the short term. We suspect that with some of these structural reforms, particularly the easing of some of the bottlenecks in the economy and trying to improve some of the infrastructure, there will be some impact of that in holding inflation down or working to reduce inflation at the margin going forward. At the same time, the strong currency in recent months will also help to control inflation. On the other hand, in the short term, if we get, which we think is quite likely, some reduction in food subsidies and possibly even some reduction in energy subsidies, that would work in the other direction. So we think that the challenge facing the central bank is quite significant, but generally our view has been for quite some time through our Indian strategy team that inflation will start to come down on a 6 to 12 month view. May not come down sharply, but will come down enough to allow the central bank to hold interest rates where they are, and even, who knows, down the road begin even to cut those interest rates. So inflation short term is a concern, but not a great concern. Over the medium to long term, we think inflation probably begins to ease lower. On the currency, I don't think it's as vulnerable a carry trade currency as some of the others that we mentioned at the beginning of the interview, such as the Brazilian real or the South African rand or the Turkish lira. I think there are improvements going on at the margin in the fundamentals in India. But if we do see a broad dollar rally over the rest of the year, our sense is that it's going to put the rupee under a little bit of pressure. And our forecast is that the rupee ends the year around the 62 level, which is 2 to 3% below current levels. So slightly weaker, but not significantly so. On the other hand, were it to rally, because more capital flows come in, and it, say, goes to 55, that would lead to an unprecedented level in terms of the real exchange rate. So we don't think that would be all that helpful. So our view is, mainly because of the US dollar itself, some modest appreciation of the Indian rupee between now and the end of the year.
Jeff, your assessment of the Iraqi crisis, is it likely to be long drawn, and will that cloud your view of India in particular and of emerging markets in general?
It's certainly a concern. I think the translation of what is clearly a very difficult situation in Iraq and a very brutal situation in Iraq into significant pressure on emerging markets generally has to come from either sharply increased risk aversion, which has really not happened yet, or through a sizable increase in the price of oil. Now, oil prices have gone up a little bit. They haven't gone up that much. What would really get oil prices moving sharply higher from here would be any threat to oil supplies again from Iraq on the back of what seems to be close to a civil war happening there now. So I think that's what you have to watch for. Is there going to be disruption to supply? Now, the risk for India clearly is obvious to all. India and Turkey are our two kind of standard economies. Perhaps Korea and Taiwan could be added to that list as well, of economies that are highly vulnerable to a rise in oil prices because, of course, the extent to which India imports virtually all of its oil supplies. And so that is were you to see a further significant rise in inflation, that is going to create, in oil prices, that is going to create some further upward pressure on inflation, which would create some dilemmas, I think, for the central bank. So I think that's the way we should see it playing out, through the risk of higher oil prices, not particularly through increased risk aversion, because so far that's been minimal.
Geoffrey Dennis, thank you very much for joining us in our maiden show, What the World Wants. Well, but we are not yet done. After this short break, we will have yet another veteran India watcher joining us, Adrian Mowat of JPMorgan.